You're listening to Boomers Today with your host, Frank Sampson.
Well, welcome to Boomers Today. I'm your host, Frank Sampson. Of course, each week we bring you important and very useful information on issues facing baby boomers, their parents, and other loved ones. And I can't thank everybody enough for all their support in sharing our podcast and recommending the radio show to your loved ones and friends. And you're probably doing that because we have a lot of great information, and today's not going to be any different. Of course, many of you listen to the show on Google Podcasts, Apple Podcasts, iHeartRadio, Spreaker, Stitcher, all sorts of online radio stations and podcast stations. Many of you go to our website. That's you could get there at seniorcareauthority.com. And we have just another wonderful guest today. We have with us Dr. Stana Martin, who earned her PhD from the University of Texas at Austin in Communication Studies. In 2006, she left university teaching to specialize in long-term care planning as a result of both her grandmothers going through extended care. She teaches required continued education courses for attorneys, trust officers, and financial professionals, and has authored 2 books published on Amazon. One is a step-by-step guide on how to file a claim successfully, and the second is called Handing Down the Kingdom, a how-to guide on getting your legal, financial, and other parts of your kingdom organized. Stana, welcome to Boomers Today. Really appreciate you joining us.
Thank you.
Yeah, so you have a wonderful background, and you have a PhD, as I mentioned to everybody. How did that PhD in communications end up with a career in long-term care?
Well, it's a bit of a checkered journey, isn't it? Actually, back in the day, I was trained in theater, which was sort of the beginning of the communication part of it. And when I went to teach at a university, one grandmother and then the other wound up with long-term care. And one side did pretty good. They had a long-term care policy and used it. And the other side didn't do so well, and there was no resource. And I just remember thinking there's got to be a way for families to do this more sensibly. And so I left university teaching kind of cold turkey and went into this particular work. So I guess it comes from a family event that stemmed a passion for what I do.
Yeah, it's such an important subject matter. Of course, I know that I'm in the industry as well, but not on the insurance side. So, you know, and I'm sure you've experienced this as well. I'm a big proponent of long-term care insurance. I'll let you know that. All right.
Oh, good.
And when I say to somebody, do you have long-term care insurance? Usually I might be talking to the adult child who's going through a lot of challenges with a parent or other loved one who didn't have long-term care insurance. They're trying to figure out, how am I going to pay for all this? This is
Sure.
expensive. You know, there's that perception that the government's paying, but we all know that's not the case in the United States. And and their response is, I heard it's so expensive.
Yeah.
Okay. What do you say to people who respond that way?
I agree with them. It is expensive. It's one of the
Mhm.
most expensive insurance you will ever opt to own. Um, to me, it's like, which devil do you want to dance with? You know, you can dance with the devil that says we're going to pay 10, 20,000 a month for care down the years. Or you can say, okay, we're going to dance with the devil that's, 3 to 6,000 per year. Now, don't hold me to those numbers. I mean, one of the things I know about podcasts is we recorded at a particular time, but somebody could be listening to this later, and the price of insurance is always moving. I just give you an example to say, it's either X per month or X per year, and the X per year is always going to be less than the cost of care. And of course, that's the crux. Which devil do you want to dance with?
Yeah. Well, the one thing we do know that this is fact. All right. Everybody's going to die, right? At least
Yes.
last I heard. All
So
right.
far in human history, that is correct.
That's correct. But there are, the feeling is that on long-term care, well, maybe not. Well, I need long-term care, and if I do, well, my kids will take care of it, or my wife will take care of me, or something
Sure.
like that. And that's probably pretty short-sighted, wouldn't you say?
Yes, I would also say it's quite human. You know, when you're 40, 50, 60 and you're in good health, you're still fairly bulletproof. And our natural human inclination is not to imagine that we're going to get worse. We sort of think, oh, well, I'm good. And so that's one of the most painful things you have to do is to take a really serious look at what do your peers' parents look like when they're in their 80s and early 90s, because that's where you and I in our 50s and 60s are going. And even though we're not there now, we've got to be realistic that if we live long enough, we are going to become fragile, either neck down or neck up. And so you need to have a plan, and that plan may not be insurance, but you need to have some strategy for that.
Yeah. So that gets me to my next question I wanted to ask you. So, generally speaking, I know each situation is going to be different, but generally speaking, who would you say sh- should own long-term care insurance? And what examples could you give of people who maybe it's not for them? Maybe they don't have to own it depending on their situation. What would be
Sure.
your thoughts there?
Well, I would say there's three key variables you have to weigh. One of them is how old are you? So, for instance, I got off the phone with a lady 2 days ago. She's 28 years old. That's probably a little young to be looking into it. I hate to tell anybody don't buy it because God forbid if they're in a car accident or something and they've got permanent spinal damage. But generally, people will start looking into this somewhere in their late 40s and up. And generally, by the time people have hit 70 years old, they have enough in their health history that we struggle to get them through underwriting. So if they've waited too long on age and health, then we could have problems.
Right.
But
Right.
that's your demographic age wise. It's kind of late 40s to early 70s, and younger is always cheaper. The other criteria, though, is also net worth. In every application out there, there is a suitability form. And that form says, do you have at least 50,000 in savings and investments that's not your home? If you're beneath that, it's probably premature to look at this product because if you had care, you would burn through your net worth so quickly, you would end up on the state Medicaid program, whatever it's called in your state. And so the recommendation is it's probably not wise if you have less than 50,000. And depending on where you are, sometimes that threshold is even more like 100,000. But if you're beneath that, it might not be a sensible choice financially. Now, on the other end of the spectrum, I've often heard people say, well, if you're worth 1 million in net worth or more, you can probably afford to self-pay this risk. And that answer is maybe. 10 years ago, that could have been true everywhere in the US. But when you look at the cost of care in places like Boston, for instance, or Seattle, you're looking at cost of care 20 years from now that could bankrupt somebody that's only worth 1 million in net worth if they have a protracted run. So I don't know what the upper end of it is. I would say it's more than 1 million today, depending on where you are. And as time rolls forward, that number could escalate. The only other thing I would say about that is my high net worth clients, they still often buy because there are products out there that are kind of a hybrid life long term care combo. And those will allow them to own a product without losing their investment. And it lets them leverage their money. So a lot of the times, my high net worth people that could self pay buy a product anyway, but it's a choice. You don't have to, clearly.
Would you say that uh, what you mentioned as the hybrid policies, which my feeling that's a pretty, I like that product. All right.
Okay.
But I'm sure every situation is different. Would you say that that's the percentage of the policies that you sell? Is that the majority, or is it a small percentage of what you sell? Is it strictly long-term care?
So that hinges on geography, to be honest. And I know that seems odd. Why would it do that? But those hybrid policies are designed largely to be funded out of your net worth. So if I am in a geographic area where the income and assets tend to be on the lower end of the US spectrum, they're probably not going to have the income or assets in order to fund it. So, but in places where there's pretty significant net worth, you're going to see those are probably the largest proportion of policies sold. So I wish I could tell you a flat yes or no on that, but it's
Yeah.
really hinges on, do you have a strategy to fund those? And if you do, they're a viable option. They're a great
Yeah.
option.
Right. Right. So, you referenced Medicaid, and, I think maybe if you could help educate our listeners here a little bit about, Medicare, Medicaid, as it relates to long-term care, because I think there's a perception out there by many that, oh, Medicare will cover it or Medicaid will cover it. So why don't you set the record straight on that?
What a nice question. Thank you so much. So here's how I tell people to differentiate, because they're so confusing. If you're not 65, you haven't really grappled with Medicare yet or Medicaid, and they sound so similar, meta something. So here's how I tell people. If it ends Medicare, it's designed to care for you until you're better. If it ends AID, Medicaid, that really ought to stand for all investments depleted, because that's the way the Medicaid program works. So Medicare is health insurance that you get when you're 65 and older, and you pay a premium for that. Now, not to go into loads of details of the alphabet soup of Medicare, some of it's paid for from your working years, but others you pay a premium for. But on Medicaid, you must be at poverty's door before they're going to step in and pick up that cost of care. So most people that have any significant net worth are going to not qualify for Medicaid until they burn through all their savings. Very simply, Medicare pays hospital, doctor, rehab, some home care if you're getting home care therapy, or if you're designated hospice. But if you need care in any environment besides that, whether it's home care, assisted living, skilled nursing, memory care, adult daycare, none of those are paid by Medicare. They're going to be paid either by a long-term care insurance product, or you self-pay the cost until you're at poverty's door, according to the state mandate. And then after that, Medicaid will pick up the cost of care. And many states will specify that you have to be in a Medicaid-approved facility. So they don't pay home care. Some states pay assisted living, some don't. Most of them are skilled nursing only.
I think, and you said it, but just to kind of repeat so people understand, Medicare is a federal program. So that's the same, pretty much the same in every state. Medicaid is a combination of federal and state. So
Yes.
there's differences state by state. Uh,
Yeah, not only do they call the name something different, like in Massachusetts, it's called Mass Health, in
yeah,
California, it's Medi-Cal. So they
right.
call it different, but they also have different thresholds for qualification, different things they will pay for. So if you think you're going to go the Medicaid route, I don't know anybody that's excited about that, but if they think they're going to go there, it's worth it to explore that, to know exactly what your state will and will not cover.
Gotcha. Great. So we're going to take a real short, promise you, a short break here just to recognize our sponsor. And when we come back, I want to talk to you a little bit about maybe some of the tax advantages with long-term care. All
Okay,
right, how's that sound?
perfect.
So I ask you, do you know anybody who may be concerned about an older driver? Well, Senior Care Authorities Beyond Driving with Dignity program is a facilitated self-assessment program for older drivers. This program has been designed to serve as a vital tool to facilitate older drivers and their families as they make appropriate decisions regarding the future of one's safe driving career. If the individual is a safe driver, an advisor will provide him or her with strategies on how to remain a safe driver as they progress through the aging process. If driving retirement is the appropriate decision, then the individual and their family are offered possible alternatives resources, and a specific plan to ensure a smooth and successful transition from the driver's seat to the passenger seat. To learn more, you can go to www.seniorcareauthority.com, or you could call 877-907-8841 to connect with an advisor in your area. We're back with Stana Martin, who is a specialist in long-term care planning. So Stana, let's talk about some of the, as it relates to long-term care insurance. Are there tax advantages with this product?
That answer is going to be probably. And the reason I sort of sound so, I don't know, like a politician, yes, no, maybe. The reason is because I'm not a tax expert. And anytime I answer this for clients, I always say, and I'll say it here, the grain of salt, please check with your tax advisor to get specific answers for your situation and your state. There are variances by state, but in general, there are tax advantages for most people. First of all, if you have a health savings account, not a cafeteria plan, but a health savings account, it's one of the few premiums that they will allow you to pay out of your HSA. Second of all, if you've got the right corporate structure, specifically a C Corp, it can be paid for through the company and it's a tax deduction there, and it does not pull through to the company owner as a charge on their income tax. So that could be an advantage. And in general, the federal taxes have a rule that says if your medical expenses are 7.5% or more of your income, and you have itemized your medical expenses, your premium paid for your long-term care can contribute to that 7.5% threshold. So if you have a bad year medically and you have a long-term care policy, you might actually have a federal deduction as well. There's probably others that I've skipped across, but that sort of gives you kind of the complexity of it. Some states even have a line item tax deduction or a tax credit. So it's worth exploring.
Gotcha. Good. So I was going to ask you after our break, maybe you could share with everybody your information. And also I was going to ask, I know you're in the middle of the country. I'm not sure how licensing works with long-term care insurance, but is state regulated? Meaning, can you help people outside of your state? And if so, great. If not, could you provide help to people who might be looking for somebody in their area?
Oh, okay, sure. So I own a company called Mrs. LTC, and that's our website. It's not very exciting. It's just MRS LTC. And if you go there and you contact us, either I will help you because I am licensed in multiple states, and it is state specific licensure that you must have. If you are from a state where I'm not licensed, I have a network of people that I trust that I would say this person would take good care of you and shoot you straight. I recommend people use somebody who specializes in this. And I know this is going to sound so, I don't know, elitist, and I don't mean to say it this way, but this is a very complex product, and it's got a lot of moving parts. And if you're dealing with somebody who only sells one company or sells one product 2 or 3 times a year, that person may not know enough about underwriting. They may not know enough about the different options that are in the market. So I always recommend people use a specialist, somebody who only does long-term care insurance, so that you make sure you're getting all your options and getting a right fit for you. This is not a one size fits all. And so you need to have somebody who can listen to your goals and tailor it to fit you. Did that make sense?
Absolutely. Just to clarify, so the people that are licensed to sell long-term care insurance could be a specialist like yourself that is licensed, and that's all you pretty much concentrate on. But there are what's called financial advisors out there that,
Yeah.
and some of them, not all of them, also sell long-term care insurance. Is that what you're trying to
Yeah, and I don't want to throw financial advisors under the bus. I have a great deal of respect for those people. They do great work for their clients in general. the reason it sort of, I hesitate though, is some of them actually sell this on a consistent basis and are well informed. Great, use them. You trust them, go with them. But if they haven't sold one in a while, or they sell one or two or three a year, the market has changed so much in the last 5 years. 5 years ago, if you got declined by one company, you could spin and apply someplace else with, abandon. These days, no. If you've been denied by one insurance, there's many of the insurances that won't take you. So working with somebody who does this consistently and persistently, week in and week out, they're going to understand the nuances and make sure that we don't set somebody up for failure accidentally. So again, not to say don't use a financial advisor, please do. Just know whether or not they have that expertise.
Great. So can we dissect a little bit on a policy? All right. So meaning, I know there's a lot of things to look at. When you hear insurance, the reaction is, well, what's my deductible and all that sort of, what's my premium, what's my deductible? What are the different aspects or pieces to a long-term care insurance policy? For example, I know there's a waiting period, and maybe you could explain that. And, maybe there's maximums that coverage, of coverage. So maybe you could just go over maybe a few of the parts of
Okay.
long-term care insurance policy that somebody, could wrap their head around in a simplistic way.
Because I just said it's a complex product. Let me do the best I can.
Okay, great.
Okay. The first thing you want to know about any policy, and even if you own one already, pull the thing out and have a look at it. You probably haven't looked at it in a while. It's worth looking at it. So you want to know, how much is it worth per day? Whether you're shopping today or you already own, that's a key piece to know. How much is it going to pay for care in today's dollars? The second thing you want to know is it growing to keep up with the rising cost of care or not? That's a rider you add to these things, and some people choose not to add it. So you kind of need to know, is it growing or is it still worth whatever it was when I bought it? The third thing to know is your time window that it will pay for care. Now, historically, really old contracts, they really were like a clock, like you had 3 years. It's 365 days times 3. That's how much you had. Your modern policies don't work that way. They actually are what's called a pool of money. So they take your amount per day, let's say it's $100 a day, times the time window you bought, let's say 3 years, and you have 108,000 in your pool of money. So whether you know the time window or the pool of money, you can backwards into the math to know the other variable. Then you said deductible. They call it an elimination period, and it is a deductible. It's the set window of time that you have to pay out of pocket fully before the insurance kicks in to pay their portion. And it can be anywhere between 0 to 180 days. It depends on what you bought or what you're shopping. Most of them default to 90, but I've seen them all over the map. And there's this little strange feature that's been sold for a lot of years where if you start at home care, they waive your deductible. So you might need to know if that's a feature you have. And then if you have a hybrid, or if you have something called return of premium, there would be a death payout. Like if you never use the blooming thing, hit by the bus, right? What comes back to a beneficiary? Not every policy has that last feature, but if you have it, that would be something you'd want to know. There are a lot of other bells and whistles, and historically there was even more than there are today. So on our website, not to tout us again, but on our website, we have a glossary of terms, and you can go there and begin to sort of say, well, oh gosh, my policy says, shared care or survivorship or whatever it says, and you can look it up in the glossary and learn what it is you own or what you're shopping.
So I know some years back, I know it's changed, but there was a time that you could get a policy and there was no maximum, meaning, whatever your per day period is, if you needed care for 10 years at that level, the policy paid for it. Today,
and those were fabulous.
yeah. So today, though, there's a max. So I think it's important for families to know, the one thing that you said as far as the what did you call it? Not a waiting period. What did you call it?
Well, it's called the elimination period, but I tell people wait period. They understand that better, but deductible is really the
but
easiest.
I think it's important because I have run into, I'm sure you have too, where, the parents say, don't worry, we have long-term care insurance. Don't worry. Great.
Yes.
Mom and dad have long-term care insurance. That's wonderful. We're covered, right?
Yeah.
And then they find out this waiting period that they got to pay out quite a bit of money in that first 90 days or 100, like you said. So that's an important point, I think, for people to know. But the other thing is the max. So if somebody is in need of care, it's possible, right, that policy runs out.
Yeah. Historically, pretty much everybody sold and bought unlimited. And you might have a policy like that if you bought it some time ago. Today, there's only two companies that have an unlimited bucket of money. Everybody else is a finite amount. And it becomes a little strategic. I read a lot of people's contracts. I don't charge for that because mom and dad bought this thing 25 years ago. They can't remember what's in it. The daughter's trying to help, and she's really a bank VP, not an insurance specialist, So they come to me and I'll read it and explain it to them. And sometimes it's strategic, like when do we use it? If somebody's at hospice, let's not delay using the policy. Let's get all the money we can. On the other hand, if somebody's been diagnosed with early stage Alzheimer's, and we know we're going to be a journey here, maybe if you've got a policy that'll pay for 3 years of care, we do choose to delay for a little bit before we use it. So knowing that lets you be more strategic about when and how to utilize that resource.
Great. So I could talk to you forever about this subject matter, but unfortunately we're out of time. So I'm going to leave you with this last question here. It's just for our listeners, where do they begin? In other words, they're listening to what you're saying. They go, I should really look into it. I'm in my 50s. I had to pay out a lot for my parents. I don't want to put my kids through that. I should look into it. Where do they begin?
Contact an insurance agent, whether it's your financial advisor or a specialist. Check with your associations, because a lot of professional associations might offer a discount within the company. So get somebody to sit down and give you a proposal. But this is a lot like doctors. The first agent you talk to could be very knowledgeable, or they could be somebody just trying to sell you something. So get a second opinion. If I'm working with a client and they say, well, I'm going to talk to my financial advisor, I never discourage that. They don't know if I'm an idiot until they get a second opinion, right? So I always encourage people, like buying a new roof or any other high ticket purchase, get more than one estimate and ask a lot of questions. That will arm you well enough to be able to say, okay, I think I can make the best choice for me.
Great. Or better yet, contact Stana. You can go to her website at mrsltc.com. That's mrsltc.com. Dr. Stana Martin. Stana, thank you so much for joining us on Boomers Today.
All right. Thank you for having me. It's been lovely.
Thank you. And I want to thank everybody for joining us on Boomers Today. Please be safe, and we'll talk to everybody next week.
You've been listening to Boomers Today with Frank Sampson. To learn more about today's show, visit boomerstodayradio.com and join us next time for another edition of Boomers Today.